Hi there, my name is Jason Ayers, Director of Business Development at Croft Financial Group and a member of the Investment Review Committee. On behalf of the committee, thank you for taking the time to watch our monthly review and commentary for September 2018. The economy south of the border continued to look positive during the month of August and now into the better part of September. This is, of course, despite continued political drama. Jobless claims are down and job creation is up along with consumer confidence. The GDP numbers for the U.S. were strong as well. Remember that an economy is considered to be in a recession or economic slowdown after 2 quarters of declining GDP. Strong numbers are a positive sign that the U.S. economy is still chugging along. Investors demonstrated their confidence by pushing the S&P 500 to all-time highs, breaking the record as the longest-running bull market in history. A point that is not lost on our management team as the Croft Group continues to cautiously take advantage of the trend. Canadian equities had a tough August as trade concerns between the U.S. and China impacted the materials sector, while the overturn of the Trans Mountain oil pipeline expansion weighed heavy on energy. Oil as a commodity finished the month of August where it started after some volatile swings and currently remains within the 67 to 69 range. Gold hit a low of $1170 but rallied back quickly to settle above $1,200. This trading behavior continues to be heavily influenced by the swings we've seen in the U.S. dollar of late. Moving on to fund performance. For the month of August, the Equity Growth Fund finished positive 3.27%, while its benchmark, the TSX Total Return Index, finished negative 0.82%. Year-to-date, the Equity Growth Fund is up 8.32%, with the TSX Total Return benchmark trailing at 2.27%. With Canadian banks reporting at the end of August, and given expectations for interest rate increases, the Canadian Financials Index approached a 6-month peak near the end of August. The Investment Review Committee took the opportunity to reevaluate the Canadian bank holdings and decided to close out a position in National Bank of Canada. Although the company had performed well in the past, according to lead manager Alex Brandolini, research confirmed that earnings quality has been weak and the upside on the financial stock is limited. Given that view, we decided there'd be better places to deploy the capital. Over the month of August, the momentum factor continued to provide opportunities in Canada and the United States. Canada Goose Holdings, a Canadian consumer discretionary stock, was added to the portfolio during the mini-momentum correction. This company exhibits supernormal growth and has a history of beating expectations, but also doesn't trade on a lot of volume. When a significant holder of shares in a company that trades on low volume chooses to exit the position, it often creates a large move to the downside and an opportunity to get in at a more favorable price. Given the fundamentals of the company, its factor exposures, and future prospects, we took the opportunity to buy the company on a pullback. Our income fund finished the month of August up 2.27% compared to the Real World Index Income benchmark, which is up 0.39%. Year-to-date, the fund sits positive at 6.20% compared to its benchmark, which trails at 1.28%. Lead manager Mark McAdam suggests that the strong returns in the fund can be attributed to the acquisition of Enercare by Brookfield Infrastructure Partners for a 52% premium. We've also seen strong active trading returns on Constellation Brands Incorporated. The fund continues to be overweight technology while reducing the weighting to the consumer discretionary sector. In addition, some exposure to the telecommunications sector was introduced. According to Mark's analysis, valuations in this sector are attractive and companies have high dividend yields. Equity exposure has also been reduced in an effort to lower the risk of the pool, and put options on the S&P 500 remain in place as part of our ongoing hedging strategy. Remember that our option writing fund is designed to drive cash flow using income-generating option strategies regardless of market direction. The fund finished August positive with a 2.26% gain, beating its benchmark, the Montreal Exchange Covered Call Writers Index, which finished the month positive at 0.30%. Year-to-date, the fund sits positive 4.44% compared to its benchmark, which trails at 3.60%. Lead manager Richard Croft confirms that implied volatility continued to contract in the month of August and remains at short-term lows as highlighted last month. This has reduced the dollar value related to the premium collected from our option writing strategies. In response to this, Richard has shortened the term to expiry with a current average term to expiration of 26 days. The objective of selecting an option contract with a shorter term till expiration is to benefit from the accelerated time value erosion, which is a characteristic of these option contracts. Richard continues to maintain a balance between value and momentum stocks. The fund currently sits with a 48.43% exposure to value stocks, 35.5% exposure to momentum stocks, and 16.07% in cash. There is approximately a 35% exposure to the US dollar, which Richard notes could be volatile relative to the Canadian dollar over the short term. This depends on the outcome of the NAFTA negotiations. Looking forward, investors continue to express concerns over the extent of the current bull market. While we continue to monitor the headlines and data closely, our analysis of current economic conditions and company valuations has given us no pause as we continue to be fully invested. According to the investment committee consensus, what's different about the new high on the S&P achieved in August relative to the peak we saw in late January is that valuation multiples look much better this time round. Much of the volatility of the last month was sparked by risks within the emerging markets. However, historically, weakness in emerging market stocks did not spill over into the U.S. markets until a significant surge in the U.S. dollar and a significant drop in oil prices. While the U.S. dollar has strengthened this year and the price of oil has come off its peak, neither are anywhere close to the magnitude associated with previous U.S. market downdrafts precipitated by emerging market contagion. To summarize, economic fundamentals continue to support a positive view in the markets. Both macroeconomic models and bottom-up forecasts, which focus on company fundamentals, indicate this bull market continues to have legs to run. That said, and as always, we'll continue to evaluate and adjust as market conditions change.